one of the first investors that we used on a fix and flip that we turned into a note. I don't remember what year that was. It was a long time ago.
2010.
It was self-directed IRA funds, and he is still currently an investor with our group today. So just, you guys know, lasting relationships and growing with each other and that trust and building that over time. So it's a long time, but it's pretty cool to still invest together.
Welcome to the Cashflow Fight Club podcast. In the Champions Corner edition, I'm Mike Deaton, and together with Lydia, my co-host in life, business, and this podcast, we're taking you into the training room, deep in the dojo, sharing the secrets of what it takes to forge a champion. We're digging deep into mindset mastery, high-performance habits, best-in-class behaviors, and bringing you the tips and techniques that maximize human potential, brought to you from some of the best in the business.
So grab your buds and your seat. Hit subscribe and get ready to up your game. Let's do the show.
Let's do it. Today, we have the pleasure of speaking with husband and wife real estate power couple, Crystal and Rick Rumer. Rick began his love of real estate when he was just 19 years old by house hacking a property he lived in and making $100 a month in positive cash flow.
After being fed up working for a finance company, he and Crystal decided they would forge their own path in real estate.
They've since explored many different asset classes in real estate, from single-family properties to larger rentals, and are now in the land development space, where they own or finance a majority of the properties they sell. This creates a portfolio of notes, much like banks have with mortgage notes. They now leverage those note payments to present you, the investor, with opportunities to earn healthy investment returns, and in turn, give them, Rick and Crystal, funds to reinvest into more great land development deals.
Let's hear more about how they got their start and how you, as investors, can earn great returns.
Let's do it. Crystal and Rick, welcome to the Cashflow Fight Club podcast. We're excited to have you guys on today.
Thank you. Thanks for having us, and glad to be here.
Yeah, thrilled to be here.
Yeah, this is exciting. We haven't had this topic on. I think we've danced around it a little bit. We personally are obviously in land. We're familiar with notes. The audience probably is not. It's not such a common investment vehicle, but yeah, we'll get into all the ins and outs of that good stuff, and hopefully teach some people a new investment class and a good way to diversify their portfolio. As a way of getting into it, though, why don't you tell us a little bit about yourselves? Brief intro and how you got into real estate.
Yeah. I was pointing at you.
Husband and wife move there. Boom. You go.
We do this all the time.
So she has a lovely introduction, but in short, I bought my first rental property when I was 19 in college. Lived in a house and rented out the rest of it, and charged enough off of the other rooms that I could pay for all of the bills and cash flow, like $100 a month as a college student. And that was like a big deal, 20, 30 years ago for me, at least.
I'm actually making money out of my place of business. Yeah. What a spark.
Yeah. It was cool. And I had friends at the time that were just like, "You're doing what? Oh man, you're gonna do so well in life." And it's interesting how the decisions I've made since then. I wish I could go back and do other things differently, but I got into working for JP Morgan Chase, coming out of a couple of years out of college. Got into investments in the traditional sense. Had some securities licenses, and then started accumulating a couple of more rental properties. And then 2008, big real estate debacle with the banks happened, and many people ran away from real estate. But I was so sick of working for the big bank that just got bailed out that I was like, "Hey, let's jump in. Let's do this full time."
Wow!
And a lot of people were running away, and we were running into it, and that's kind of how we got really started full time investing in in real estate.
Yeah, he literally came home and said, so we had some rentals. And he said, all right, babe, like, we're going to do this real estate thing full time now. And so we started doing fix and flips. We started wholesaling, and we had some rentals and some fix and flips that didn't go according to plan. And that's how we started originating notes. We had a fix and flip we couldn't sell. We had a rental that in all places of Houston, Texas, it froze, and our renter bailed out and got to the house and pipes busted and the whole place was flooded. And so we were going, surely there's got to be a better way. And through all that, we got into commercial as well. We ended up building a housing facility for oil field workers for Schlumberger, Halliburton. Mm-hmm. And so started doing that for a time, and things were great when, oil prices are great, but can get vacant really quick when oil prices change. So done a little bit of this and that, I would say. And then we really found a love for notes. We just saw that for us personally, for our own portfolio, wanted to accumulate more notes. And then on the origination side, had a friend back in 2016. He was doing a lot of similar investments as well. And we did some transactions together. But back in 2016, he ended up switching over into land and then started piquing our interest on the land side. So I would say it's funny because it was like, we've tried this, we've tried that. It's like, ask us what not to do.
We'll get to that. Yeah, that's fascinating. It's really fascinating. So let's rewind a little bit. 2008, the market's going south. Real estate prices, especially, crashed. Banks are not lending for primary residences, let alone investment properties, I would think. But you guys decided to lean into that. How, you explained you had a decision that you said, hey, let's go in. But what was your thinking there? Did you just come from, the financial background and maybe this awareness of be greedy when others are fearful type mentality, or seeing deflated prices and seeing opportunity there? Or kind of what was the spark to lean into that moment?
I wish I could say it was a really well thought out, intelligent decision.
Honesty. I love it. Yeah.
But it was more about being done working for the man. Kind of got to that point in my career. And
you'd been doing some day trading as well.
Yeah. Always looking for opportunity. And, we had taken some real estate courses, and that year, Jamie Dimon, the CEO of JP Morgan Chase, he held out for quite a while. It was one of the last banks to take a bailout, but we did end up taking one. And that year, our sales quotas were getting push. You got to make money, make the company look really good, and they were cracking the whip, right? And he made a $33 million bonus that year, which was at that time, it was a record bonus of some sort, whether it was the company's record or a Wall Street record. I have no clue, but I just remember going, man, like he cracked the whip and I made a whole lot of money for that guy. Maybe not me personally, but us as a company did. And I was like, I want to be on the receiving end of that. I want to go chase my own dream. And so it was more of I'm sick of working for somebody else, and yeah, prices are down. And it wasn't so much about blood in the water, run in. It was just like, prices are down. If we can afford to make this move now, like this is the time to do it, not when prices are high. Mm-hmm. So,
and you guys? Go ahead.
No, I was just going to say that was also a time when we stepped into that. There was a lot of foreclosures, short sales happening that we were not familiar with. We, like I said, had some rentals, but it was a whole new area that we started exploring on the real estate side that we ended up working with another investor that had a little bit more experience than us, that we got to glean from and work side by side together on, because at that point, I think we both were just ready for change.
Mm-hmm.
It's a great motivator. I mean, it helped push us into real estate as well, out of corporate careers, some other things lined up. So I'm assuming then, but you can correct me on the story, that you had a bit of a cushion. You had some money in the bank. You went into this knowing that, okay, maybe even if things don't work out, we have a runway that we can survive on until we get back in? Or was this
So
I'm laughing because we had a cushion, but it went fast. It went really fast.
Were you self-funding your deals, like when you got your fix and flips? And
no, we were definitely looking for hard money in private funds.
Okay,
borrowing from self-directed IRAs.
Mm-hmm.
But as far as like our own personal finances, it was like, okay, we have a little bit here. We can do this. They always say have 6 months worth of reserves, on hand. And the interesting thing, since you're asking, we had just found out, this was our 3rd year wedding anniversary. Right around that time, we had just found out that we were unable to conceive and have children. And so that was off of the board, right? And health insurance when you're younger isn't that big of a deal. And so it was quit this and let's go do this full time. And then we found out like a month later that we were pregnant after we had just quit this corporate job, right? And then there's this little law or rule that you can get back your insurance, and it's called COBRA. And they're like, oh, it's not going to be any more expensive than it was when you were with them. Right. Except your employer was paying 90% of your insurance. And then all of a sudden she had a pre-existing condition, and we're trying to get insurance, pre-existing, known as pregnancy. And then we're trying to get insurance, and it just went through the roof. And then it was a long, difficult pregnancy. Well, normal length, but very difficult pregnancy. We had a lot of complications, but
really sick.
Our proceeds, we went through that pretty quick. So.
Yeah, thanks to medical bills. But our son ended up coming early. He was 8 weeks early. He was in the NICU for quite a while. I was sick in the hospital as well. So when you say like, did you have this cushion? It's like all these things really kind of snowballed, but I will say it really helped us then grow quickly, because we really couldn't just sit on the sidelines and not do much. We had to be active. And in fact, as our son, he was super tiny. And at that time, we also had a business, we didn't mention this, but over in the Seychelles, we had started a bottled water company over there. And so that was kind of a side, totally different thing that we were working on. And so we took him everywhere. We went to the Seychelles with him. I would be the one, I was never an agent. We had an agent work for us, but when that agent wasn't available, I would be the one to go show the homes, because we were owner financing these homes, or we were flipping them, whatever that we were doing. And so I would have my son basically on my hip or in the carrier everywhere where I would go. And then during the day, I would also be putting out, 100 a day offers. I mean, like just crazy amount of offers, because at that time there were so many foreclosures happening, and we were just trying to gather as many homes as we could, as fast as we could, because again, we were just not able to necessarily sit on the sideline, and it was hustle time for us.
It's amazing what you can do when your back's against the wall, right? And so we didn't think of it as fortunate at the time, but we were fortunate to have motivation to get some things done.
I was about to say that situation really brings a certain urgency to make it happen, that if everything is kind of comfortable, you lack that urgency to really drive you
it can
forward.
happen.
It
Yeah,
can happen.
it triggers that fight or flight, and you guys decided to lean in. It sounds like and fight through it rather than go back into finance or try to get a job somewhere, which I don't remember at that time, but probably wasn't a great time to be out looking for jobs.
Right.
Especially at the bank.
That's
Right.
great. So you were trying to sweep up all the deals you could get. Were you putting things on a purchase order or a purchase agreement, or like I'm assuming there's a dance between getting a deal and finding the funding and those kind of things, or did you have?
Yeah, our preferred method was wholesaling, getting things under contract, and we had built up a network of other real estate investors that had the means to pull the trigger. Early on, we didn't, and yeah, it was largely about getting them under contract and moving those, whether that was through double closings or through assignments or whatnot that we could do that. That was, I mean, how we were doing it early on. Yeah.
Yeah. And then, like you mentioned earlier, we would use someone's self-directed IRA. We did use some of our funds, but really, especially during that time, we wanted to use little of our own personal funds as possible. And at that time, we were connected with a self-directed IRA group and started using funds from there, because then we had more of the expertise and able to use private funds in that way, as well as hard money.
I think, and this is a lesson for everybody who's listening to this, whether they're new in real estate or they've been in real estate for a while, creative real estate especially. We're pretty niched down to what we do now.
Right.
But starting off, we were willing to chase down anything, and there's a large aspect of letting the deal dictate what you can do, how you can get in a deal or out of a deal when you find one. And so I think that's really what gets the creative juices flowing early on. Once again, is some of them are better to buy and rent. Some of them are better to wholesale. Some of them are better to flip. But you kind of have to let the deal dictate. Once you get one, we would send out blind offers. We would never see the house. We would send out hundreds of them. And then when you get one accepted for 50 cents on the dollar, it's like, well, let's go look at what we have under contract, because we didn't have a clue. And then you go out and you see the neighborhood and you pull some comps and go, okay, here's what we can do with this one. Maybe you go back and ask for a further discount.
Sure.
But
no, it's a great strategy, really, in real estate, but also outside of real estate. When you understand the business and the different methods and exit strategies and things like that, then you have a lot more flexibility. I mean, even in stocks and bonds and different things, right? Different market conditions, people make money because they understand the different strategies and the way to play the markets. It's the same in real estate. And yeah, there's a lot of different funding options, as well as using your sweat equity, using other people's money, all that kind of stuff. I mean, it's just a wide open field, and it's really what we love about real estate. It's also really what we love about land, is because there's so much more flexibility in terms of the different ways you can play the investment. And you can just straight up flip it versus develop it all the way and even own the structure on top of it and continue to cash flow off of that. And so maybe it's a good moment to shift into that. So you guys found yourself, after going through a lot of different business models and strategies, you found yourself finding someone else who was doing larger development deals with land, and decided to go into that. Maybe step us through that moment and that process, and explain exactly what that business model is, at least what it looks like today.
Yeah, I think the margins on originating on residential for notes at the time were getting smaller and smaller. So then looking at doing the land, and essentially what our business model is that we buy large parcels of land, 100 acres, 400 acres, and then we subdivide them and go ahead and cut up those tracts, and then we owner finance those tracts. In Arkansas, as well as in Texas, anywhere from 3 to 5 acres, or in Texas are going to be 5 to 12 acre lots. And I would say over 85% or about 85% of the ones that are buying those properties from us are owner financing them.
Mm-hmm. Yeah, maybe
us.
if we can just, maybe for the audience, just explain the language a little bit, what a note actually is in this owner financing context.
Yeah. Well, let's slow it way back down. A note, by definition, is any time that it's the documentation that comes along with a loan.
Yeah, promissory note, right? I promise that I will pay you $500 a month for the next 30 years or whatever.
That's right. Yeah. You have so let's say you're buying a house, you're buying a car, there's a promissory note that includes all the terms, the how long it's going to be and what the payments are going to be and what your interest rate. You also have, at least when you're talking about real estate, you have a deed that conveys ownership, and then you have a deed of trust. And the deed of trust is what collateralizes that piece of real estate with that promissory note. This is what allows a bank or a note holder to foreclose on a property and go take that back if they don't make their payments. So yes, those documents together are referred to as notes. They can be bought and sold on the market. If you've ever had a mortgage to Bank of America, and all of a sudden you get a letter in the mail one day that says you no longer pay Bank of America, you pay Bank of the Southwest. That's because your note has been sold by Bank of America and purchased by another bank, and they're now going to service that note.
Yeah, speaking of the 2008 financial crisis, right, it was sparked by a lot of unhealthy note parsing and selling and stuff.
Yep.
Like that.
So some people are better at originating notes. Some people are better at managing the notes, or that's like to hold on to the notes for the benefits that provides. It kind of depends on where you are as an investor or where the bank is, as to what their strategy is and what they're trying to accumulate. But yeah, so when we talk about notes, it's literally the documentation, the paper behind a real estate transaction. And to once again, just to say it one final time, everybody I know of has been a part of a real estate transaction, whether it's their personal or investment. And they said, but I really still don't understand notes. And I go, okay, well, sit on the other side of the table. That's the note. It's the same documentation that you signed. You're just on the receiving end, as opposed to
you're acting as the bank, right? You're lending money to someone, and these are the terms. And so I think a lot of people might be very familiar as well from cars, right? You go in and you buy a car, whether it's used car or new car. There's a set of documentation that says the same thing. And I think institutionally, notes and I guess buying and selling of notes is very common institutionally among banks for mortgages and things like that. For used cars, I think it becomes a little more close to the individual. There's a lot of people that will buy car notes. They'll buy the second and third year of a car note or whatever, right? And so you give the car dealer gets cash in their hand that they can then use to capitalize, and an investor gets a return on that for doing that. So it's kind of similar to that.
So some of the benefits of a note is, your upside and you know your downside going into a transaction. It's written out. I'm going to receive 11% on my money. Okay, so that's it. That's what you're going to get. The downside is if they don't pay, you're going to take back that property. So you do a little due diligence on the borrower. You do a little due diligence on the property. You obviously want to look at the paper and make sure everything's in order. But your
an expense, right? From your side as a lender, if you have to foreclose or do something, there's a certain amount of costs that are involved, right? There's lawyers that get involved. There's potentially evictions or different things, right? So there's a pain that if that happens, hence some due diligence up front, and why banks go and I guess mortgage lenders give so much attention to credit and, your payment history, and how are you a good buyer or are you at risk?
Yep.
Right. That's why it's so important we go through a full vetting process with our borrowers, as well as you want to make sure your underwriting is clean as well, because there is a market to sell the notes. We have some investors that will buy a note for 2 years and then turn around and not keep that note for the full, say, 15 years, but then turn around and resell it because there is a market for that. But they love the cash flow and to do the due diligence one time. And we focus on states, Arkansas and Texas, which are really lender-friendly states. So when you're talking about a note, it can be a little bit tricky depending on what state you're in, but making sure that you're getting a note in a lender-friendly state.
So once again, we buy large tracts of land, split them up, and then sell those individual ranchettes, as we like to call them, to buyers that are looking for their own little piece of heaven. They want 5 or 10 acres. Ours are usually set out from town a little ways, where somebody can, build the dream of their homes and have some peace and quiet. Especially since COVID, people have really been wanting to get out of the big cities. So our buyback box, what we're looking for, is property 20 minutes outside of town, but can still go in town for groceries or go to school or have their job there. So we're turning around, we're selling these to, average people, right? I can't remember the latest statistic, but I think I saw somewhere around 50% of America is unbankable right now, because of this current environment that we're in. So we're just we're underwriting them and financing that purchase for them and creating this note. Now these notes that we create are 15-year terms. They're 9 to 11%. Once again, they're on land that's 5 to 12 acres. Usually, borrowers have credit scores of 600s and 700s. They're putting down various amounts that often dictates with the interest rate that we're going to charge them. But we've gotten pretty proficient at creating these notes, and if there's a bottleneck in our company, it is now finding other investors like yourselves, like us out there, that would be willing to pick up this note and receive that monthly income.
So let's step through that a little bit. Let's just say Lidge and I want to invest or buy some notes. You guys have just outside of Dallas or Houston, right? You've bought 400 acres. You've subdivided it into 10-acre parcels. So you got 40 of these 10-acre parcels that you've sold to end users. And so you as lenders have a stack of 35 notes or 40 notes if you've done it 100% out. And so now you're offering that to the public and saying, hey, if you want some of this, we're happy to allow you to come in and draw some interest off of these notes. And so what does that process kind of look like roughly if we were to come in? Is there a minimum amount, or how does
Great question. First, let me address why we would want to sell them. If these are so great, why would we want out of them? And that is, we're just looking to recapitalize. There's a big outflow of money to accumulate this property and then to owner finance. That's a large outflow of money. Well, we need to get a little bit back a little bit quicker than on a monthly basis. So we're looking to recapitalize so
cash
we can go
flow,
do
right?
this.
You spend millions of dollars to purchase a big tract of land. Right. I don't think we touched on it, but you've told us that you might rough that in a little bit, right? Put some dirt roads or concrete roads. Some infrastructure has to go along with that, right? If somebody wants to use the property, it needs electricity, maybe some sewage type work or whatever. And so you've spent quite a bit of money, and now your notes are over 30 years. And so, yeah, you at some point, the money starts to run thin or run out. Right. So this is a symbiotic relationship for you to say, hey, give me some cash today. I will give you a preferred interest rate on that. And it's a win-win for us over time. And
yeah, so exactly. Thank you for explaining that. That's just kind of the position we're in. So who do we look for are the passive type investors, the ones that there's certain investors that want to slog it out and they want to create things. They're always looking for the next deal, and we've been there, absolutely. And of course, we're still doing it quite a bit, on our end, full time. But then there's other investors that aren't doing this full time that still want to diversify their portfolio outside of stocks or something like that. That's kind of the people that we're looking for. Now we will sell a partial principal of a note. Let's say it's $100,000 note. We'll sell $20,000 of that. That's kind of our minimum threshold. We like somebody to come up with about $20,000, and we'll sell them portion of the note. But we will sell other notes. Probably our average note size is around 200,000, 150 to 200,000. We have some upwards of 350 or so. Every once in a while, we get some smaller ones in the $50,000 range. But what somebody would expect to do is, we've already closed at a title company with the borrower, with the person who bought that property. We've already closed at a title company. We've utilized an RMLO that we talked about vetting. We've utilized a residential mortgage loan originator who has vetted the purchase price, has vetted the borrower, and says this is a good deal on both sides. No one's gouging each other. And that this person has the ability to repay that loan at the time of the closing. So we also pull, the buyer will pull their own title policy. We'll pull what's called a lender's policy. And we'll utilize a third-party servicing company to service this note, which means when the borrower is making a payment, it goes to the third-party servicer. They escrow for taxes and insurance, and then they send the proceeds to us, the note holder. So when we're looking for an investor wants to move forward, we basically transfer all of that documentation into their name. Okay, just like I said, the promissory note, the deed of trust, all of that gets transferred over. We give them the lender's policy, so the lender or the bank or the investor in this particular situation knows that they have first lien position. They get their payments on a monthly basis from the third-party servicer, and they have some peace knowing that this borrower was vetted, and it was a good loan to invest in. And so people ask me all the time, they're like, Rick, I'm going to give you $100,000 for a note that has a $100,000 balance on it. And I'm going to give you that. Yes, it's 10%. It's a 15-year note. When do I break even? Because their thought process, I'm going to give you $100,000. I'm going to receive a little bit over $1,000 a month, $12,000 a year. There's a certain amount of time that's got to go by before I break even. And I try to say, hold on. You're breaking even. You're making money. You've already broken even. You're going to make money the first month. That first month you receive, I think in that particular example, a 15-year note at $100,000 at 10%. I think that payment is $1,078. So you made $1,078 your first month. And then the next month you made another 1,000. And the next month you made another 1,000. So 2 years has gone by. You've received over $24,000 in monthly income, on payments coming in. But now you want to sell the note. Well, what's the note worth? Well, if we remember how an amortization schedule works, they pay mainly interest at the beginning. So that $100,000 note has only been paid down to roughly $96,000. So you've received $24,000, but if you wanted to sell that same note, if you sold it at par that you bought it at, you could sell it at $96,000. So your break even moment, you didn't have to wait 7 years, to break even. You started making money that first month, because once again, there's a reason why the banks do this, right? They know what they're doing. They're going to begin making money immediately on their money. And of course they can sell that note down the road. So the same thing would apply to any investors that we're looking for. We would transfer the documentation into their names. It would take about a week or two after they've done their due diligence. They can close at a title company if they want to. They can close in an attorney's office. They can sign in their home office if they want to. There's no need to close at that title company, but they can if they want. But we'll give them that lender's policy and transfer that third party servicing agreement into their name. And the first month, they just begin receiving that mailbox money.
We laugh and just say it's not sexy. I mean, it's really simple and easy. And so I think a lot of people, they want to get their hands dirty on something, but that's why we love it, because it's just really simple and you're just transferring paperwork really and receiving cash flow.
Yeah, as you mentioned, there's a lot of people that do want just passive income, or they have an IRA or self-directed IRA that mandates that they have some kind of passive investment in there, right? You can't be actively in there managing your own investment, so you have to invest passively.
I do have a question. So when, as an investor, if we buy the notes from you, we will get the notes with a lower interest rate than we sell the note. The notes are sold for. Am I understanding that correctly?
No.
Let's say you have $100,000 note, but I only have 20,000. Then, are you only selling the back end portion of notes, or can you buy a chunk in the middle? Or that gets a bit. I think that's not clear how that works.
So yeah, when we sell a partial note, so there's multiple. Partial is pretty ambiguous. There's different ways you can do a partial note. You can do a partial principal, which means that's kind of what I just described. Here's $100,000 note. I'm going to sell you 20% of it, and you will own 20%. You'll still have first lien position, but you will own 20% of a $100,000 note. I call that partial principal, because you're buying part of that principal of the note.
And in that scenario, but in that scenario, let's assume the borrower makes their payment. Is it every month that gets split 80-20 to you and the person that has the 20% over the life of that note, or is that if it's a 10-year note? That's
correct.
Okay.
Yeah, that's correct. The term hasn't changed. The interest rate hasn't changed.
You're just co-owning that note.
Yeah,
with somebody.
Yes. The monthly payment hasn't changed, to the borrower. So they're still going to make that same monthly payment. But yes, it will be split up. You're going to pay for 20% of the note, and you're going to receive 20% of the monthly income. It's still going to be, if it's a 10% note, you're still making 10% on your money. There's an outflow of 20,000. You're going to receive 10% on your money on a monthly basis. It's just a smaller amount.
Yeah.
Right.
It's clear now. Thank you for that.
And you've mentioned this 10% figure. Oh, sorry. Go ahead.
I was going to say there's also partial term notes as opposed to partial principal. And this is kind of what you were indicating. You can buy the first 5 years of a note and leave the remaining portion of a note to the original seller. That would be buying part of the term. There's also partial interest notes, believe it or not, where if you have a 10% note and you bump into somebody who says, what did I say? 10%?
Yeah.
If you have a 12% note, let's change that example. If you have a 12% note in your hand and you bump into somebody who says, I just want 10% on my money. Okay, you can actually sell them 10% of that interest, and you can receive all your principal back, but keep making 2% every single month. Keep the spread on that, basically. Those are very creative ways to do it, and aren't necessarily common, but it is possible. We stick to the partial principal format, where once again, the idea is to help somebody who doesn't have enough funds to take down an entire note themselves. If they can only afford 50% of one or 75% of one, then we'll sell them part of that note. And once again, they still receive the same interest rate on their money. It's just they didn't put 100% of it in, so they don't receive 100% of it.
Mm-hmm. Okay. Sounds like it's a very simple business model. Like the investors don't touch the terms. The terms are already set for the buyers,
right,
and they just invest.
Correct.
They just buy as much as they can afford.
And if I were to come to you guys, let's say we have $100,000 and say, hey, we'd like to get into diversify our portfolio with some notes. Like I'm assuming you have in your portfolio, it sounds like varying notes of varying interest. Like, some buyers are getting a 12%, maybe somebody's an 8, maybe somebody's, I don't know, but it sounds like there's a variety. Would we then choose from that? Or how does that work? Do you pick our brains in terms of like, hey, what kind of return are you looking for? And we have, these notes fit your, or is somebody else even handling that for you guys? Or
we would, based on what your criteria is or what your buy box is, what you're looking for, then we can get you into a note that's going to best suit you and what you're looking for and what your goals are. So it's just going to depend. Yes, I would say average is 10 to 12%, but we have some getting less and some getting more. So it's just going to vary. We love notes as well. We deal with a lot of accredited investors, but we also work with non-accredited investors as well. And so I love being able to help single mom or someone that's never invested in real estate before that goes, hey, I've got X amount. I can't buy a full note, but I want to get into investing. And that's huge for us because the entry level is lower and you can still invest and get an above average return, double digits on your return. And I hate to use the word secure. We got to be careful with that, but it is very, it's a lot, I hate to say a little bit more secure than a lot of other investments. And so with notes, again, they're not sexy, but they're just simple and they're going to give you your cash flow and above average return each month and each month.
Let's talk about the risks just for a little bit. I think it's important to call that out. I mean, we're familiar with I mean, this is our business as well. We own or finance land. We typically do it for a shorter amount of time, 5 years on average. They're smaller purchases. We're familiar with buying and selling notes in our industry. And the way it typically happens is, let's say Lidge and I have 100 notes that we're collecting on every month. And somebody, we say, hey, we need a certain amount of money. We're going to sell off a portion of these notes. Somebody comes in. Well, in our business, typically what happens is, let's say we sell somebody $50,000 worth of notes. That equates to 5 different note documents or 5 different notes. Well, in the event, we won't max that out. We won't sell every note we have in our portfolio. We'll leave 20% or something. And so that it's very rare in our business that somebody defaults, but it happens. And so if that happens in somebody's note portfolio, we can swap that out so that it's it's very it doesn't impact somebody that's bought notes. I don't know if that's the same in this case, because it sounds like somebody's buying an actual specific note. So in the event that somebody defaults and you have to foreclose, or how that would play out for an investor. But let's maybe explore that risk.
It's very similar.
Right now, everything you said is spot on. Right now we have, at this moment, we probably have about 50 notes, averaging around $200,000 a piece, which means we have a decent portfolio. So when we sell onesie twosies, or small packages of them, yes, foreclosures do happen probably, I would say 2 to 4% of the time. I would like to say it's pretty low due to our vetting process, but it does happen. So we like states that are lender friendly, that there's a reason why we're in Texas and Arkansas. Here, you can hire an attorney that we've used before, costs about $2,000, takes about a month to get done. And we can either help you reload that note by listing your property for sale again and allowing you to go find a new buyer, or we do have a portfolio of notes that we can consider swapping one of them out for you, like kind, if there's something reasonable, which at this time we certainly have some very similar notes that we could swap back and forth.
Yeah, we want to keep our investors happy.
Yes.
I mean, and I'm sure you have seen this too. It's like with land too. Once you buy one note, one piece of land, you're going to buy another. I mean, they're going to come back. And so our note buyers, someone asked me the percentage today. I need to find out exact numbers, but we have a very high percentage of first-time note buyer coming back and continuing to buy more notes.
Yeah, I would say,
I mean,
of the people that have owned one of our notes over a year, I would say over 80% of them come back and buy another one from us.
And that makes sense the way you guys do it, because you want to sell those notes so you can have more cash, so you can buy more properties, and to do this all the time. I have a question. How do you guys find your properties, and do you use banks or you use private money when you purchase them?
Yeah, if you're going out and buying 400 acres, are you finding that on the open market, or are you finding direct campaigns to multiple property owners to get that 400? Or
well, Crystal alluded to this earlier in the call. Single family homes is getting competitive. There's fewer buyers out there. There's fewer congestion and competition for these larger parcels of land that are set out from town. If you want to buy some big parcels in town, you're going to be competing with a lot of people. But yes, we have agents that work for us that are looking for property for us outside of town. We'll utilize an agent. It can be a pocket listing, or most likely it's going to be on the MLS someplace, and we'll utilize that. We utilize a variety of private money, hard money loans to purchase it on the front end. A lot of it, I'd say most of it is going to be private lenders. And then these private lenders are part of the deal in the beginning. And as a certain portion of it gets bought up, they'll end up trading their equity in the deal for some of the notes. And so they'll just kind of pick up some of the notes that we create from that. And it's been a pretty good working relationship with them. But
yeah, one of the first investors that we used on a fix and flip that we turned into a note. I don't remember what year that was. It was a long time ago.
2010.
It was self-directed IRA funds, and he is still currently an investor with our group today. So just, you guys know, lasting relationships and growing with each other and that trust and building that over time. So it's a long time, but it's pretty cool to still invest together.
Yeah, so it sounds like a really great way for pretty reliable returns, very low risk. What type of money do you guys accept? I guess that's a funny question. What what sources of money will you guys accept? Let's maybe rephrase that in terms of like SDIRAs, good. Obviously, direct investments and things like that. But sounds like accredited and non-accredited. Just pretty much thing goes here.
Yeah, I mean, you hit it on the head there. Self-directed IRAs is a big deal for us, and that's kind of where we get into the partials from people that rolled over a small 401k. Have been working a place for 10 or 15 years. They have something small or whatever. Self-directed IRAs, private funds. We run in circles of other real estate investors that are doing larger deals, and some of them made a good chunk of change on maybe some multifamily investment or something like that. And after they get out, they exit. They're like, "Hey, I want to buy some notes. I want to diversify into this, and this."
Yeah, cash and bank. I mean, some people that have inherited funds, just cash sitting there. Our biggest thing is get your money working for you. Don't let it just sit in the bank, and get that working for you somehow.
I think
some way.
that's an important point to bring up. I used to be a financial advisor, right? I've looked at these little charts that show if you invest money for 30 years at 8%, if you invest the same amount of money at 10%, and if you invest the same amount of money and get a 12% return over 30 years. And they show these little charts to 18-year-olds to get them to start an IRA early, and they're very powerful tools, right? You look at it, and here's one thing I want to bring up. You look at making 10% on your money over 30 years and it compounding, right? And it looks really good. I had one person challenge me one time, and they said, "Well, what if your money is sitting on the sideline just 10% of the time? You take out those last 3 years of compound interest, and you take out those last 3 years on a 30-year term. Your money was invested 27 years, but though you made all of your money in those last 3 years, you took your money out only for 10% of the time." And so there's a lot of real estate investors that are private lenders that are looking to lend hard money style on a fix and flip, and they're going to get a 15% return, or they're going to get an 18% annual return, but they're lending it for 6 months at a time or 9 months at a time. And they say, "Well, I want that big return." Well, they do their due diligence, every 6 months on a new investment, and they got to keep doing that. And so they're doing a fair amount of work. And then when they get their money back, it sits on the sideline for a few months before they get into their next investment. And once again, there are people that wake up every morning and they love to deal. And that, I'm not speaking to that person. If you're not that person and you just want your money to work for you, I like the idea of notes because it's going to be a longer term. You only have to do your due diligence once, and you're going to, if you take those earnings, let's say you're making, those monthly payments, and save up those monthly payments, buy another note, save up those monthly payments, buy another. This is what the banks do, guys. This is why they have the big buildings and they're making so much money, is they're reinvesting their interest that they're receiving, and they're doing it on another loan and on another loan and on another loan, and they're passive in all of them. I tell people, nobody calls Bank of America in the middle of August when their AC goes out. It just doesn't happen. But they make that monthly payment even if their AC has gone out. So I just like to educate people a little bit on, once again, notes aren't sexy, but that 10%, 12% uninterrupted, just month in and month out, is a very powerful tool. And most people lose track of when they get in this investment and then they want to get in that one and they want to get in that one, that their money's sitting on the sidelines sometimes for long periods of time. in between those two investments. So
yeah, we get a little bit in the weeds here,
Yeah.
but that is a fundamental difference in most investors, myself included, don't have the discipline to stay into an investment for 30 years, right? We don't make an investment in Apple and just let it sit. We see the peaks and the valleys, and we think, oh, well, Tesla is going to be a better investment, so I'm gonna cash out my Apple and go into that or whatever. And so, yeah, we don't get this steady return. The stock market also doesn't really generate those types of returns. I mean, okay, yes, over the long term, but that's on a whole, right? You got to be lucky to pick the one or two companies that are also going to perform over time, or buy an index fund. Then there's fees on top of all of that. And so you're not really seeing that net return. I think real estate in this way is great because it's more like a drip, a dividend type stock, where you're actually getting money in your hand every month on this investment. So you can, like you said, reinvest it into other things. And so, yeah, the power is just from what I'm hearing, it sounds a little bit better than traditional stock, bonds, mutual fund type investments, just because of all the things you just said. So somebody wants to do
biased, but yes, I think it is better.
But also, you guys know, in the land side, land value continues to go up and up, and
it's
so
much better than residential or even commercial. Going up and down. If somebody wants to get into the game, or at least hear a little bit more, what's the best way for them to get in touch with you guys?
Send us an email or give us a phone call. We like phone calls. We're real people. We answer calls. I'll say my number right here, and you can put it on the screen. My number is 817-845-6764.
Yep, mine is 907-342-2214. We have a website, texassecurednotes.com. Or you can go to Rick at texassecurednotes.com email, and mine's Crystal at texassecurednotes.com. But we always love to educate and share, because this is an area like you guys sharing about land, educating on the land side. We love to educate on the land and note side, and how valuable that is, and about more than just building wealth, but also building that legacy too.
Mm-hmm.
That's great. Yeah, we'll drop all those in the show notes for anybody watching or listening. Make sure they have those. It's a powerful vehicle, and definitely worth exploring a little more. It sounds like something I love the fact that it's so flexible. To your point, you have accredited and non-accredited investors. So a lot of investments are hands off for the majority of the public. Especially with these kind of returns. And so, yeah, it's a great vehicle there.
Absolutely. I was just going to share one last thing. We had a lady that came to us. She had been at her job since 1993, and rolling over her 401k into a self-directed IRA. And I mean, since 93, that's a long, long time. And we were just really blessed and humbled that she had been at that career for so long, and entrusting us with a note for that amount that she had. And although it wasn't enough to do a full note, she ended up bringing in a relative to combine funds, and then they buying a full note. But all that to say, it was just like, she was steady, reliable, and she wanted steady and reliable. And so it was fun to get to do that transaction with a note with her. So you don't hear stories like that very often. I was like, wait, 1993, what was I? Where was I at that time?
I wasn't born, so that's fine.
Right there with you.
I so wish we had more time to talk to you guys. It's been fascinating to hear what you do, and we like to end each episode with gratitude. And I wanted to ask you if you have someone in mind. It doesn't have to be just one person that you want to shout out to that has been instrumental in your life and has helped you be where you are today.
You can't say each other.
You can say each other.
I'm not going to say that at all. I'm going to say our daughter, we adopted our daughter. She comes from a very rough background. Her and her mother were sex trafficked. We fostered her and brought her into our home. And after a year, her biological mother was asking us to adopt her. We very much wanted to. And that was 9 years ago that we got to adopt her. And she every day challenges us in ways we don't see coming. But
she's our biggest cheerleader.
But it's about legacy to us. It's about she could have been in the same position that her mother was in, and now she'll never be in that position. The people we talk to on a daily basis, we're caretaking on both of our family side, and the idea is to create legacy. If we're gonna make wealth for ourselves, let's make wealth for others also. And so she challenges us to do that each and every day. So I would say, waking up every day, she's the one who's pushed me to the next level and required more of me.
That's beautiful. We didn't touch on this, and I know we talked before the show, but if you have a couple of minutes and you want to talk about your charity work and the things that you work on, I'm happy to allow to give you a couple minutes to share that with the audience as well.
Go for it.
Yeah, just because of that situation with our daughter, it really drove us to start a nonprofit and build a home for women and children that have been sex trafficked. So that was up in Alaska. And then we worked with another nonprofit that we worked on the rescue side. So we would work with FBI and local law enforcement. But I think, again, it was just, again, the legacy, leaving that, and generationally changing the trajectory of not only our daughter's lives, but others' lives that we touch too.
Yeah, it's beautiful. I mean, it's money's one thing, but when it has a purpose like that, there's so much more that can come out of it than just an interest rate or materialistic things.
I just want to say one other thing. That organization up in Alaska, I'm more than happy to share it with people. I was going to say, if you each want to reach out, if somebody wanted, well, I don't know, should I put it out there or should?
It's up to you. I mean, if it's an organization and people can donate to it.
Yeah, I mean, there's a 501c3 up in Alaska right now, Priceless Alaska. I think it's pricelessalaska.org. They can donate there. They are mentoring women coming out of sex trafficking up there in Alaska. Would love to, if anybody's touched, to support them, however much that is. I think they would be blessed by that.
Yeah, that's amazing. Well, thank you both.
Yes, thank you.
This has been really educational, inspirational in many, many ways. And it was a pleasure getting to talk to you, and wish you all the best. And if we can help you guys in any way, please let us know. But thanks again for coming on the show.
Thank you.
Thank you for having us. It's been fun.
Yeah, this has been fun, and learning more about you guys. And thank you for letting us share. You guys have been great.
Yeah, it's powerful. Well, take care. We'll talk to you out there in the real estate world.
Okay.
Sounds good.
Great.
Thank you.
Thank you.
For those of you joining us today, we hope you enjoyed this time in the Champions Corner as much as we did. Got some awesome takeaways, and most importantly, will take action to continue living your best life and maximizing your potential. Mindset is such an important aspect of life, and when coupled with action, delivers undeniably powerful results.
Please subscribe to the podcast to hear from more great guests and get the latest mindset mastery insights and cash flow matchups.
Again, thank you so much for investing your time with us, and we look forward to seeing you next time on the Cash Flow Fight Club podcast.